Thank you all for being here. Lovely to see you. It's always nice January is always a fun month in the metal space. We all get to spend time together, dream about what the year might bring. And that's what I am doing in this presentation. Perhaps not dreaming so much as trying to think through or trying to explain how I'm approaching investing this year. I often just sort of talk about the metals markets, but instead I tried to structure it this time for specifically how I'm approaching a junior mining portfolio this year. So this is I'm sure a common knowledge for everyone in this audience, but I think it's worth reminding because I often get asked, well, how are things? Like, what do you think is going to happen this year? And it's a very multifaceted answer, always, because metals are not one thing. They move on their own timelines, right? They move with their own catalysts and on their own timelines. And similarly, stocks within one metal arena also will move on their own timelines because that's just the nature of how the markets work. And I just threw together a chart there that has uranium, copper, and gold over the last, 5 years? And yes, there's some correlation between those moves, but there's also a lot of divergence in those moves, right? And so it's just a quick demonstration of, things don't move together. When we get into a raging, awesome bull market, then everything goes up. But turns out we're not there. I don't think that's a surprise to anyone. And so if you're going to build a junior mining portfolio, I think it's quite important to focus in on what you think will happen now and why. And so what metals do you believe in for this year? And why do you believe in them? And I guess I said for this year, what metals do you believe in and what time frames do you believe those metals will move on? I'm a big copper bull, but I don't have a huge amount of reason to believe that copper is going to move in the next 6 months. So I think it's important to frame your expectations specific to each metal and with some time frames within that, because I think that helps you determine how to structure your portfolio. So that's the approach that I'm taking today. The one that is happening now, that I'm sure we are all familiar with, is certainly uranium. We're going to do an entire panel on uranium tomorrow afternoon. I decided we needed to do that at this year's MIF because uranium is just that dynamic right now. Quick statement on why this is happening. I mean, it's certainly a supply-demand situation. Just so the price has doubled in the last eight months, the spot price of uranium. Remember that the spot price of uranium is a real transacted price. There's not speculation built other than, the speculation inherent in utilities deciding when to buy. The spot price of uranium is a calculated average of the deals that have happened on a particular day, right? There's no futures market. There's no options trading on that. So it is a real number. Just last week, it was up 13%. And that was for two reasons. First, Kazatomprom admitted that it is not going to meet guidance this year. Not a surprise to anyone who follows the uranium market, but still a notable statement. Watch in 2 weeks when they actually release the numbers of what that miss is going to look like. We don't know how much they're going to miss by, but they said that they will release those numbers by the end of the month. So that could be another significant moment in the market. So they're not going to get there. Kazatomprom matters. Kazakhstan makes 40% of the world's uranium. Their cutbacks was a big part of what righted the uranium market. Their restarts were supposed to help fill the gap, not fill it. That wasn't ever the plan, but they were supposed to help smooth the path back towards reasonable production. And now that's delayed by 1 to 2 years. But the thing is that we're out of uranium now. That's why the price is moving up so much. Utilities are paying double what they needed to pay 8 months ago because they still need uranium. And the interesting thing is that a lot of utilities, and especially in America, have significant restocking needs right now. Why didn't they buy when it was cheaper a year ago? Well, there was a lot of uncertainty a year ago about whether the uranium market was actually going to bifurcate into this east-west thing. So a lot of utilities just held off because they're like, we don't know whether we should commit to Kazakh uranium or not. We just want to see how this plays out. Now it's becoming quite clear how it's playing out. The United States is really leaning into the bifurcation. The other piece of news that boosted the uranium price 13% just last week was the United States Department of Energy pledging $500 million to support the build-out of nuclear fuel processing capacity. That matters because guess what? Russia controls 80% of the ability to turn yellow cake into nuclear fuel, that processing capacity. America can't rely on nuclear as part of its future if that relies on Russia. So America has really been leaning into supporting domestic uranium mining and uranium processing. And just every time that's reinforced, that government support for uranium, every time it's reinforced, the market's like, oh yeah, that is a big deal. Oh yeah, if America can't rely on Russian uranium, that really matters. And so that's another thing that contributed just last week. As for this supply gap, there is some new production coming online over the next year, but those are what we call the easy pounds. Those are mostly mine restarts and ISR projects that have been in the works for the last little while. After that, it takes the hard pounds, which are new hard rock mines, and those take a long time to get going. So that's just a short way of saying that there's no quick solution to this problem, which is why I'm comfortable to say that the uranium price is going to go higher from here and is going to stay elevated for quite some time, because there just isn't an answer to this problem. This is a Cameco slide. This is before the Kazakh news. Cameco put this supply-demand chart out before Kazakh's cutbacks. They may well have already incorporated their presumption that Kazakhstan wasn't going to be able to ramp up its mines the way that it thought. Kazakhstan can't get sulfuric acid and isn't spending enough to build new wells. So those are the two things that are happening there. Okay, so if I talk about building your portfolio based on what metals you believe in and on what time frames. Well, uranium is happening now. I believe in it and it's happening now. That means you can invest across the risk spectrum, right? You can invest in explorers, you can invest in developers, you can invest in producers. They all work when the metal is actually going. In this particular case, because of this east-west divide that is so significant in this market, I think growing U.S. production, and it's been clear already in the stocks that growing U.S. production is likely to outperform the other segments of the market. And then those advanced projects. Now, the cupboard of advanced projects is very, very limited. So I've put two there, NextGen being clearly the standout asset in the world. Fission also in the running. There's not a lot out there. And it's also important to remember that the uranium space is just really small. There's not that many stocks to even choose from. They've kind of They've already gone through the ringer. There was such a long bear market that a lot of the, to be blunt, crappy ones aren't really around anymore. So you can play across the spectrum. You can do whatever you like. Of course, discoveries will get rewarded, but you don't have to take on the risk of discovery in a market that's moving this strongly and has this much impetus. And I think still has a lot of investor interest yet to come into the equities, because the hesitation hangovers from the last 10 years of a uranium bear market have still impeded, or at least until 2 weeks ago, had still impeded the equities responding to the spot price. That's changed in the last 2 weeks, but I think there's still more leverage in the equities available from the amount that the spot price has gained. Bottom line, there's a lot still to happen in uranium. You can play across the spectrum. It's the fun place to be. Okay, gold this year. What is important about gold is that it held its ground through the rate hikes, right? That's super impressive. The gold didn't decline during that unprecedented rate hike cycle. I mean, it's really impressive for those of us who care about gold. It actually doesn't matter for the equities, because it turns out nobody cares about a sideways market. So that's where we've been living. That is significantly shifted now, right? Now rate cuts are coming. The central bank buying, which is what kept the price strong through those rate hikes, is continuing. That's the green and purple chart that's down there at the bottom. And you'll note that the last bar on the chart, which is for 2023, doesn't have the light purple segment yet, which is Q4. So that bar will likely jump up to be, who knows, as notable or perhaps more notable than the 2022 bar, which was already sort of an all-time high. And the chart is bullish. Now, those are all the pros for gold. The fact that we're going into a rate cut cycle is really significant. That really matters for gold. That's what the other chart shows, that gold responds, gold rises when rates go down. But the thing is, rates aren't going to get cut tomorrow. I mean, there's still supposedly 55, 59% odds of a rate cut in March. We'll see. I do think that gold's next leg up is going to require the market to get confident that that there is a rate cut coming, and soon, like sort of knowledge of that. So either the Fed saying that it's happening, it actually happening, or data becoming weak enough that we all get confidence that it will happen. So I'm just saying, I don't think that gold is necessarily going to run tomorrow, because I don't think we're necessarily going to get that confidence tomorrow. And that is the most important factor in the gold price right now, is when these rate cuts happen. So that's why the timing is uncertain. So you can do with that as you will. When timing is uncertain, the risk is that you are confident that the gold will go, so you deploy a bunch of capital in, and then you're left waiting for an uncertain period of time before getting any return from that. So I think the more cautious option, or the more capital deployment savvy option, is to focus on the stocks that move first and most when investors turn their attention to gold, because you can deploy some capital into those for the exposure to the stocks that move first when this happens, and then you can be ready with those list of stocks that you want to buy when the investor interest turns in, and then you can deploy into those at that time. So what are the ones that will move first and most? Well, producers, and then those rare assets, and there's two on the stage with me right now, that are building or close to building big new mines. And this is rare. There's not a lot out there. There's all kinds of charts out there that can talk about how we're lacking in gold discoveries and projects moving along the timeline and all of that. But buying those are rare. Those are valuable. The majors need them. The market needs them. So I think that that's a good place to play, to play your gold cards for now until we get that confidence that the rate cuts are here, coming, and the market then will start to go, which I think will happen this year. I'm just not going to say, I just don't think it's going to happen tomorrow. Okay, copper. I mean, I love copper. I'm a copper bull. The charts are very obvious. The things that I'm showing here, the first chart is obviously copper supply demand. Guess what? We haven't been building enough new copper mines for like 15 years. That's a long time. We haven't been doing it because executives have been conservative, investors have been disinterested, and permitting keeps getting longer and harder. Put those three things together, the number of copper mines being built just keeps falling. Discovery and development rates for the deposits that we have also just keeps falling. I came across a cool table over the holidays that went through the top 40 copper development projects in the world. And this quote is from the guy who put that table together. 31 are facing significant challenges: social, environmental, regulatory, economic. And for quite a few of those, that means that the viability of the project is got a big question mark beside it. If you limit that 40 to just the projects that could reach production in the next 10 years, like they're at late PFS or feasibility stage, so like we're actually getting towards being able to build a mine, there are 23 projects, and 9 of them can't make progress, like blocked from progress, and another 5 have significant permitting risks. So they've either been blocked in the past and are currently progressing, but I mean, that's 14 out of 23 that's not good for the number of projects that can't progress when 23 wasn't enough to begin with. So we're not discovering it, we're not advancing the projects, and we're not building the mines. So I believe in copper for sure, but I don't think, again, that it's going to happen next. And the fundamental for that is just that investors buy commodities to position for global growth. They buy copper when they see growth. And we're not yet at a stage where investors are like, yes, what I need to do now is position my portfolio for intense global growth. And I think the China GDP chart is part of that. It's not terrible. It's not exciting. It's not encouraging investors to specifically position for growth, which is what a copper market really needs. So you either need a market that is positioning for growth, or you need to actually be out of the metal, which is what's happening with uranium right now, right? Uranium is an energy commodity. So again, it would usually fit into that global growth required investment arena, except that we actually ran out of it. And so the price moved because we ran out of it. So I think one of those two things basically needs to happen. We need to either run out of copper, or we need to get to a position of global growth, or both of those start to play up more. So we're just not quite there yet. I really believe in copper, but I just don't believe that it is going to happen in the near term. Silver, very similar perspective to copper. I think of silver primarily as an industrial metal, which is why my outlook on it is very similar. You know, we had a real ramp in demand over the last 3 years that created much larger deficits than the market usually has. The deficits in silver are always met by recycling. Over the last 3 years, they've been really met by dishoarding because there hasn't been that investor interest. So coming out of ETFs and coming out of personal holdings. But that can't last forever. And recycling is less and less because the silver in solar panels is very poorly recycled. So both of those will be able to contribute less going forward. And I think the going forward picture is a real ramp in silver demand once, again, I sound like a broken record here, once we get to that sense of global growth, once investors are positioning for global growth, because then we get that ramp in solar demand again. We get a ramp in the industrial side of silver across the board. And so that's when the lack of the things that have covered the deficit for the last while will show up. And I think silver can do quite well. Again, we just need to get to growth or physically running out of silver. Lithium is an interesting one, right? So what a price chart, right? Obviously went absolutely mad in 2021 and 2022. That's when the Chinese EV subsidies were crazy. And so everybody went crazy for lithium because of the sales forecasts for EVs in China. Fair enough. The lithium price soared 700%. Wow. But then in 2023, China did not renew those subsidies. And that had a bit of a cascade effect on a price that had probably gone a little bit too high or had definitely gone significantly too high. And then combine that with high interest rates in lots of parts of the world, and specifically in the United States, impacting car sales in general. And EV demand fell. And so lithium plunged in response. The interesting thing is that Chinese electric vehicle sales are actually at all-time highs. That's what the chart that I've borrowed from Maven at the bottom is, like all-time highs for electric vehicle sales in China. And the Inflation Reduction Act means that the subsidies in America have made electric vehicles generally cheaper than combustion vehicles on an apples-to-apples basis for different kinds of vehicles. And now the US has this official target of like increasing EV market penetration from 5% where it currently is to 50%. That's insane. I get it. There's all kinds of problems with that. But the point is that there's a lot of lithium needed for that. And America's subsidies are only applicable to cars that are made without Chinese lithium. That means the US, to actually reach that 50% goal, which, like I say, is not a reasonable goal, but nonetheless, to actually reach that 50% goal, America would have to produce 40 times the lithium that it currently produces in the next 6 years. Like, lots of problems with that, but that's the official structure here. So what's interesting about a price that has come off this much is for a commodity that is in significant demand and where demand will probably just continue to rise, is that does suggest opportunity. Is that tomorrow? Well, I'm lumping lithium in with sort of silver and copper in that I think they all require that investor focus on growth. And if we can get to a point where investors are interested in global growth, then I think all three of those are well positioned to respond to that. And when that happens, the easy move is to just start with the producers. And producers you can choose for scale of production or for margin. And then those big advanced assets, like I suggested buying for gold right now. These are just examples of what copper companies, big producers did in the last copper bull market, right? So when it happens, it's going to be great. I don't think it's happening tomorrow, but that's the kind of thing that you can do, that you can be ready to do when we get to that moment. Now, the exception to all of these rules that I just laid out, timing and patterns and leverage and trying to, play it properly, is exploration. Because discoveries shoot through the roof no matter what's happening in the metals markets, right? So here's a few from the last 3 years: 2 gold, 1 copper. They work in any market, right? They really, truly do. I could have put NextGen made its discovery at Arrow in the heart of the bear market, and the stock did phenomenally well, right? Discoveries work in any market. So that's the other thing that you can do, right? Those are my avenues to trying to find profit while I wait for the bigger markets to just help us on all of those leverage sort of ways. Of course, pre-discovery stocks are the hardest to find the winners. They're absolutely the riskiest and the hardest. Here's the few tactics that I try to deploy to just increase my odds there. One is that you got to own quite a few because the odds of success are just not that high. No matter how good you are at picking stocks, no matter what your geologic knowledge and capital markets connections, it just doesn't happen with as high a rate of success as we would like. So don't just put all your eggs in one explorer, that's for sure. Own a bunch so that you have multiple shots on goal. If you can buy in financings with warrants, then you'll be really happy for the ones that work, right? Because those warrants will give you the opportunity to add to your position at hopefully a below market rate if you do end up with one of these significant discovery winners. If you end up buying significant positions, of course, be aware that some of these explorers have very low trading volumes. That said, if you get a massive discovery, the trading volumes go through the roof. So that can change. At the same time, if you do get that massive discovery, I do encourage you to take some profit if a discovery causes a price spike. I mean, we just saw it with Hercules. I still really like Hercules, right? I still really like the potential for them to delineate a significant porphyry there. But the market expectations got very, very high. And then the second round of holes didn't quite live up to that really, really high expectation. And so the price came off. So people probably wish they'd sold some at $1.50 because now it's trading at 75 cents. That is very common pattern with new discoveries. So really consider taking some money off the table if you get a significant discovery price spike. In these markets, it's rare to regret selling. It's just sort of a bottom line. And then overall, since I talk about how to build your portfolio, I always like to emphasize that you need to know why you hold each stock. And I've just put some categories here, like, do you own the stock because it's leveraged? Is it a takeout target? Is it building a mine and should re-rate to production? Is it because it's doing work that should change the scale of the asset significantly in the near term? Is it a discovery growth question? Is it a catalyst-based thing, which I mean like a discovery-focused thing? Know why you own the stock. And then if that reason changes, make sure you act, whether that means changing your thesis, selling, buying more, whatever it is. Just make sure you know why you own the stock and act on those reasons. I think you guys know who I am. If you'd like to know anything else about what I do with my letters and how I try and help people play this wonderful market, I'm here. I would love to talk to you all. I'll have a little subscriber session. Anybody can come and talk to Peter or I. Specifically at the end of the day tomorrow, we'll just be in here when the wine is being served if that helps you track me down amidst the chaos. Thank you all for your time.